You all here to be with you, and it's very good to see the publication of this report with its detailed thoughts on both the opportunities and the challenges to growth which exist. You also have a fascinating agenda this morning, and I look forward to hearing and reading about the results of it. India has undoubtedly set very ambitious emission reduction targets. It's pledged to reduce the emission intensity of GDP, which I think is a wonderful phrase, the emission intensity of GDP, by about a third by 2030, and to increase the share of non-fossil fuel sources to 40% of installed power capacity by that same date. According to estimates by the government, that means $450 billion a year invested every year for the next 10 years for renewable energy and urban sustainability. Wow. Well, ladies and gentlemen, I am a banker, and I want to make clear at the outset that we approach this issue here at London primarily from the angle of measuring the risks of climate stress. Because the Indian green finance market is at an early stage of development, but India already has the second largest green bond market amongst emerging economies. It's issued $7.2 billion of green bonds to date. That's a lot more than the UK. And we read, as we might expect, that there are some significant barriers to growth, managing foreign exchange risk in a cost-effective way, overcoming the challenges associated with small project size, the absence of supporting infrastructure for green finance to enable the market to take off. Just a few of the issues mentioned in the report to focus on. There is a lack of transparency, comparability, and visibility of green projects, and more. Well, I would like to give you some background to the UK's own journey in the green finance space, with now a new Green Finance Institute established, set up by the government, by BEIS, the Department of Energy, and the City of London Corporation, and its first, as the Lord Mayor mentioned, its first Chief Executive recently appointed. And I think it's also worth saying that the UK is on a journey here too. We may not have the problems of managing forex, but we can share challenges around project size, around transparency and reporting. For instance, I feel we should also make a distinction between London as a green finance centre, where there's a burgeoning and extremely active ESG green finance discussion, and the UK as an issue of green debt, whether it's corporate or municipal or sovereign. And as I said, we've approached this issue from the outset from the angle of measuring the risk of climate stress and looking at commercially viable outcomes. If they're not commercially viable, they won't fly. Paris gives the overarching background to this, but we have to live day to day by individual financial decisions on lending, on investing, on insuring. And I am hugely optimistic about the future of this market for reasons which I will now briefly elaborate. Of course, the economic risk of climate change is complex, which is why it's taking some time for consensus to form. One simple reason is that carbon dioxide emissions are long-lasting, with consequences far beyond the normal decision-making horizon. 20 years, not 12 months. Yes, there's a strong scientific consensus on the fundamental connections between greenhouse gas emissions and rising temperatures, but the probability of different economic outcomes is highly uncertain. Even accurately measuring national carbon levels turns out to be more challenging than we thought. So how do we bankers, how do we financiers take that into account? Well, here's the heart of it. The fundamental problem for us in finance is the market failure that occurs when the long-term costs of climate-changing emissions do not get taken into account. Famously, a phrase first coined by 19th century William Foster Lloyd as an economist, his classic name for the dilemma, the tragedy of the commons. No market player today needs to worry about negative consequences far off in the future. Governor Mark Carney made direct reference to this himself in his tragedy of the horizons. No one today needs to take responsibility for the long-term consequences beyond their urgent, traditional, short-term decision-making horizon. It is one failure of traditional capitalism for which it can be criticised. And it's an area of market failure where governments can make a real difference through taxes and through limits on business. In essence, we know we need to move from an economic model that relies on resource depletion today to one that doesn't, especially as this has the potential to generate trillions of dollars of additional economic prosperity. Now we understand that, how should we react? At the same time, there's a growing understanding in the finance community of the economic channels through which climate change may affect forecasts and thereby also economic policies and corporate response and share price behaviour. This is true of direct physical risks and physical damage, as well as the costs of transitioning to a fossil-free society. In the last year, many of the most newsworthy non-political events here have involved the short-term impact of extreme weather events, such as the consequences of storms and floods and fires and crop failures. And not just in the US or the Pacific Rim that this is seen. The drought in several European countries has led to forest fires and to lower production and higher prices for agricultural products. This affected balance sheets and share prices across a range of industries. Climate risk became more real. And the economy is going to be affected by political reaction to climate change and by how popular opinion reacts to them. So last year's German economic slowdown was partly due to lower auto production because of new emissions tests in response to Dieselgate. And the Yellow Vest Gilets jaunes protests in France were triggered by political petrol tax increases and contributed to reduced activity in the service sector in the fourth quarter. Jaguar Land Rover wrote off £3.6 billion for last year, largely due to political, climate-related decisions about diesel engines. We bankers who lend money to the auto industry are having to change all our internal credit ratings for the sector according to climate criteria and a forecast of what governments are likely to do. This affects the capital we have to allocate to each loan. Jaguar Land Rover, to whom my bank lends, suddenly became a more expensive loan. That's life. This is highly relevant, particularly as we approach an election here in the UK, where climate is really on the agenda, and so on. So any banker or investor, UK or Indian, who is not thinking now about how to introduce climate risk into their analysis of companies or their selection of stocks is likely to underperform. Similarly, I don't meet any corporate treasurers or finance officers here in the UK who are not aware of the need to address climate concerns from shareholders, from investors, and from risk analysts. A decade ago, sustainable investment was about signalling awareness, but sometimes at the cost of a slightly lower return. In the last 5 years, most investors have started to assume that they can do this without sacrificing return. The reality is that both green bonds and sector-neutral equity ESG strategies have been outperforming their benchmarks for at least 2 years. This is a trend that is here to stay and will get even stronger going forward because now it's not just about signalling awareness, but about mobilizing capital for business investment that can speed up the transition. It's about risk, it's about managing risk, it's just as much about getting a commercial return for doing that. And there are fundamental economic reasons why companies that invest in sustainable technologies are likely to get stronger growth and lower default risk in the future. The renewable energy cluster in particular is already showing growth patterns identical to those seen in earlier product revolutions. The first part of the story is about technology. This says that as the new energy technologies are now superior to the old, even in the absence of a climate crisis, markets will drive up growth and drive down prices at the same time. It's already happening. Solar is there, wind is there, battery, it's clearly coming. Hydrogen power, possibly coming. Tidal, I believe it's a possibility. Fusion, let's see, that may be a bit further off. But for an investor, buying into better technology on a falling cost curve and leading the way embedding those factors into your business model has always been the driver of long-term competitive advantage. You just have to decide what those better technologies are. This was the case with computer chips and memory. The very first wave of electrification, steam engines, it's the same story. Growth up, prices down. Don't we all wish we bought shares in Microsoft or Apple in their early days? Or Henry Ford tractors 100 years ago when some people said tractors will never take off, it's so much more trouble, so much less economic than a horse and cart. That's what they said. Maybe they still do in some rural parts of India, but leaving that aside, the revolution has been extraordinary. Going forwards, lenders and investors are likely to see it as a red flag if companies don't disclose exposures, and they will shift allocations towards those that have the most credible transition plans. It's already happening. The bottom line for equity investors and analysts is clear as well. In the future, every sector research team will have to include a ranking of companies in the energy transition race as part of its company analysis. And investors should abandon sector exclusion strategies, oil and gas, cement, energy, steel, and focus on including sustainability in sector-neutral stock selection strategies. The second part of the story is about politics and regulation. All the scientists suggest that renewables growth is not fast enough, and we need to move much faster to halt the climate crisis before it's too late. As a result, there is a powerful incentive for societies to speed up the transition process using any means available. Again, regardless of climate discussion, the power of politics and society is there. Politicians know this. They don't always know how to tackle the problem, but they know it's there and that they have to do something, like banning diesel engines or encouraging renewables with subsidies. And I think it's worth saying that the regulators are also playing a key role in, for instance, catalysing TCFD implementation. And through their landmark report, the Network for Greening the Financial System, the network of central banks, has been giving very strong statements of intent on climate risk as they measure bank stability. The UK government, led by the Department of Business, Energy and Industrial Strategy, very much demonstrating its commitment to addressing climate risk, stimulating a robust environment for green finance through the Clean Growth Strategy and the new Green Finance Institute, which I chair. The Green Finance Institute is financed by government and the City of London in the first instance, is led by bankers, and is positioned as the principal interface between the public and private sectors regarding the development of green finance, purpose-led finance in the UK. We aim to mobilise capital to fund the transition we need as quickly as we possibly can, and transform the way that we behave financially. And it's happening. Just look at the growth of the ESG, the environmental, social and governance investment market. In the 4 years since the Paris Agreement was signed, the sustainable investment market, which the High Commissioner referred to, grown at an annualised rate of nearly 20%. 2018 saw $60 billion of net inflows into ESG funds and 280 new fund launches. BlackRock predicts that ESG exchange-traded funds will grow to $400 billion in a decade. The phenomenon is especially noticeable in Europe. At the end of 2018, 3/4 of all ESG funds were domiciled in Europe, and 88%, nearly 90% of inflows in new funds were from European investors, and primarily driven by European pension funds and policymakers, with interest bubbling up across the high net worth and millennial populations as well. And sustainability has emerged from glossy corporate responsibility publications to become a key part of corporate strategy for many of our clients. Oil majors Shell and BP have announced a commitment to link executive pay with emission reductions, and 2018 saw more environmental sustainability shareholder proposals passed than ever before in the United States. And the European Commission released its most ambitious legislative agenda on sustainable finance to date to incentivise, to mobilise capital flows into climate risk mitigation and adaptation activities. To conclude, I think this UK-India Green Finance Working Group, set up in 2018, is going to be vital in unlocking the capital for green infrastructure development in India. I hope they will discuss every possible subject, from the role of multinational development banks all the way through to corporate reporting and the creation of further green finance products. UK and India-based members of the working group will work towards connecting these opportunities in India with private capital and service providers in London. In particular, the working group will explore both the barriers restricting the flows of capital into viable green projects, which the report elaborates on, and the challenges faced by Indian companies in raising finance. And whilst the report focuses on the challenges to scaling green investments in India, it also makes a series of practical and targeted suggestions for improvement. So there is also a clear role for the UK and Indian governments and for the financial services communities on both sides to step up and take action. I'm looking forward very much to seeing the progress, and I welcome FICCI's enthusiasm, including their offer to host a deep dive roundtable on the report on India for participants to unpack the recommendations and establish a clear set of next steps. I hope we will share our experience and work together. I think we have a lot to learn from each other and to establish a code of best practice which meets the needs and opportunities we each see. And I'm particularly looking forward to holidaying in Rajasthan in February. Thank you very much.